Thank you. Thanks a lot to the organizers for including our paper. My name is Theis Jensen. I'm a PhD student from Copenhagen Business School. And this is joint work with Bryan, Semyon, Malamud, and Lasse Pedersen. So we know by now that gross returns, that is, returns before trading costs, are predictable, either by factors or more recently via machine learning. But there's a growing concern that especially machine learning tends to get this predictability by overweighting hard-to-trade stocks, thereby resulting in non-tradable portfolios. So in this paper, we ask whether investors can benefit from machine learning after taking trading costs into account. And what we do is to argue that portfolio strategy should be evaluated based on the net returns that they can produce after trading costs for each unit or each level of risk. And we call that the implementable efficient frontier. Then we're going to use theory-guided machine learning to generate a powerful implementable efficient frontier. And then we're going to show which characteristics really matter once you take trading costs into account. So here, I want to show you the implementable efficient frontier that you could generate from different portfolio methods. And by the end of this, I'm going to sort of argue that our method is superior, but let's not go there yet. Importantly, in this paper, we consider price impact to be the primary trading cost. And as such, it's really important to think about the wealth of the investor, because larger investor will have larger price impact. So here in this plot, we look at an investor with a wealth of $10 billion by the end of 2020. So before we think about the implementable efficient frontier, let's start by thinking about the standard efficient frontier. Now, the standard efficient frontier is just a straight line with a slope equal to the maximum Sharpe ratio that you can produce. So before we think about trading costs, what really matters when you're using machine learning is just to generate a portfolio with a high Sharpe ratio. And that's why, it doesn't really matter if it's, it's just about finding these forecasts to produce a portfolio with a high Sharpe ratio. So we do this in the paper as well, and we sort of use a machine learning model to predict returns over the next month. Then we create a portfolio based on those predictions, and we show that we can actually get a Sharpe ratio of 2 out of sample. So that's, of course, very high and very attractive for an investor. But what happens, and that's basically the standard efficient frontier that I'm showing here. But what happens once we think about the cost of trading this portfolio is that after cost, the net returns, Great. Wow. Is that the cost of trading this portfolio is massive. So you see that here is the return or the efficient frontier before trading costs. But if you look here in the bottom left corner, you see that it quickly goes into the negative territory once you think about net returns. So one of our first results is to show that the standard use of machine learning results in non-tradable portfolios. And the reason is that this prediction model doesn't care about the liquidity of the stock. You'll tend to overweight relatively small stocks, and you'll tend to focus on predictors that are very fast, meaning that you have a high portfolio turnover, you have a high trading cost, and therefore you have negative net returns. So of course, we also consider some models that work once you consider trading cost. And in particular, the first one, one of our benchmark is what we call static ML. So here you use the machine learning forecast over the next month, together with covariance information and trading cost information. And what you do is to maximize utility over the next period. So we show that that can work reasonably well. It's not optimal because you're only thinking about what will happen over the next period, whereas you should be thinking about how that trade is going to affect your future investment opportunities. Nevertheless, static ML can work reasonably well, but one thing that we find empirically is that using this in just a standard way will actually result in you taking on too much risk out of sample. So even though this is a high Sharpe ratio, after trading cost, what happens is actually you take too much risk, so you get negative utility. So we show that you can actually improve on that by adding an additional layer, which we call portfolio tuning, whereby you force this method to take less risk out of sample, and there you can actually get positive utility, and you can generate this implementable efficient frontier. Now, this is a relatively sophisticated benchmark, but we show that our preferred method, which we call portfolio ML, can actually do significantly better. And in portfolio ML, we use machine learning to learn about optimal portfolio weights using a loss function which is equal to the investor's utility. So by using this economic objective, we're sort of forcing the machine learning model to focus on predictability among large and liquid stocks and to focus on persistent predictors which will result in lower turnover of your portfolio. So by using this economic objective, you can actually improve on this static ML by 20% in terms of net Sharpe ratio and 60% in terms of utility. So basically, our takeaway is that the standard naive way of using machine learning to build portfolios will not work after trading cost, but using machine learning together with an economic objective can actually result in an implementable portfolio which gives you a high utility even after taking trading cost into account. Now, so this was the summary of our empirical results. Now let me go into the model. So we consider n risky assets trading at discrete points in time. And in our empirical analysis, we're going to think about roughly 1,000 of the largest stocks traded at a monthly frequency. Now, these stocks have excess returns collected in the vector R. We assume that the variance-covariance matrix is constant over time. Then for each of these stocks, we characterize them by a vector of characteristics. So that can be, the size of the stock, the book to market, and the momentum of the stock, and so on and so forth. We stack those together, and then this S matrix will have all the security characteristics. We assume that these characteristics contain all information about your expected return over the next month. And in particular, we assume that expected returns are generated by this general function mu of characteristics. So if you know these characteristics and if you know this function, you can perfectly predict their expected returns. In terms of trading cost, we assume that the investor has market impact every time that they trade. So for a given trade, this is a vector tau, the market impact you'll have on a single share is determined by this trading cost matrix lambda. And as a result, what happens is that your total trading cost will be quadratic in the dollar amount traded. So what happens, we can just think about your trade moving the price of a single stock in a linear fashion. Of course, if you do more, you're moving the price of a single stock more. But then to compute your total trading cost, you have to multiply that by the number of shares that you're trading. And therefore, once you have price impact, the total trading cost becomes quadratic in the amount traded. So you could contrast that with proportional trading costs, which would happen if you only had to pay the bid-ask spread. That would be easier to work with, but market impact is actually the more relevant cost for a large investor. So that's why we consider this form. Now, we assume that the investor wants to maximize their net of cost mean variance utility. And to do so, their key control variable is their portfolio weight, so the the relative weight that they put on different stocks. Here we're talking about fractional portfolio weights. That will be the dollar that you own in a particular stock divided by your total wealth. Now we assume that the wealth grows at an exogenous rate, and you can think about the investor as being a hedge fund, and then their clients will put money in and out, take money in and out of the fund. So we do that partially for tractability. Then in terms of the actual trade that you have to make, the way we compute that, or the way that will happen in reality, is that you have the dollar amount that you want to hold today at time t. Then to see the amount of dollars that you have to trade, you have to take this relative to the dollar amount that you traded the last period, but also you have to take into account how the returns of these underlying stocks have happened. So the portfolio that you're trading away from will not be exactly the same as the portfolio that you bought last period. So this is actually a significant complication, and one of our theoretical contributions is to handle this portfolio growth. So if you do this in terms of fractional portfolio weight, you can write it like this, where you have this G term that controls the growth in your underlying portfolio weights. As I said, this will be a complication, and this is something that we contribute on handling. Now, the objective for the investor is to choose the portfolio weights at any time to maximize the mean variance utility. So this would be the expected returns before trading cost minus the trading cost and minus a penalty for the portfolio variance. Now there's three things that I want you to take away from this utility function. The first thing is that the optimal portfolio today will depend on the portfolio you inherited last period. So when you're trading, you need to think about how your trade today will affect your utility over the next period, but you also have to think about how that trade is going to affect your investment opportunity set at all future periods. Now, the second thing is that even if we express everything in percentage returns, the investor's wealth is actually part of this utility function. And the reason for that is just that we're thinking about price impact, and for the same change in your fractional portfolio weight, a larger investor will simply have a larger price impact. So this is why I said that the optimal portfolio will differ for different investors, and it will depend on the wealth of that investor's portfolio. The third thing I want you to take away is that we assume that the relation between the investor's wealth and this trading cost matrix is stationary. And this just captures that trading $1 million today is cheaper than trading $1 million 30 years ago. On the other hand, wealth has sort of grown over time, so the trade you're making today is larger than the trades that you were making 30 years ago. And we just assume that these two effects exactly cancel, such that you have a constant relation between your wealth and the cost of trading. So what's new here? Well, there's two things in this specification that makes this well suited for machine learning. The first is that we are considering expected returns to be a general function of security characteristics rather than, say, a linear function. The second thing is that we are considering stationary state variables such as percentage returns and fractional portfolio weights, and this makes this specification well suited for machine learning. Now, as I said before, this portfolio growth, like thinking about how the returns of the underlying stocks changes the portfolio that you inherit, is actually a significant complication. So our paper on the theoretical side is closely related to this Galliano and Pedersen paper. But Galliano and Pedersen focus not on fractional portfolio weights, but rather the number of shares that you're holding. And therefore they have to think about returns in terms of price changes rather than percentage returns. And the reason is that the number of shares that you bought last period will be exactly the same number of shares that you inherit this period. So it won't be affected by the returns on the underlying stocks. And as a result, by focusing on the number of shares, you can actually assume that this G is 1, so it goes out, so it gets canceled. The issue, of course, is that price changes are not stationary empirically, whereas percentage returns are. So on the theoretical side, our paper is really a generalization of Galliano and Pedersen that makes it more well-suited for machine learning implementation. Yes? Sorry?
I think I missed something about the objective. So the objective seems to be a static one each period.
No, you want to sort of maximize that.
Well, but the utility that you're writing is the static utility. It's not some discounted flow of these utilities. So I'm just confused. You're saying you're maximizing. I would have expected a dynamic program or a sequence problem where when I choose pi t, I understand that tomorrow I'm going to start with pi t. That will be my state variable. But what's written here, so is this just a within period payoff function? And that gets fed into a dynamic program?
Could you justify this with log utilities? It seems that because you have that gamma there, that's not possible.
No, but did you say that the wealth?
Okay, explain it.
Sorry.
So you mentioned that the wealth process was exogenous because you're thinking of hedge funds getting flows in and out.
Exactly, yeah.
So the whole point is that the reason why you have today and tomorrow linked is because of wealth. But if now you break it down, then that doesn't matter anymore, right?
No.
No, I mean,
You're
this
not
is...
selling every time?
Sorry?
Sorry, you go ahead.
No, maybe I'm misunderstanding. I mean, we are considering that you want to maximize your utility at all future points in time. So you want to maximize your expected utility at all future points in time. It's not just that you want to maximize your utility over the next period.
Okay, so this is just the within period payoff function.
Yes.
And what you're actually maximizing is the discounted present value of these utilities.
Exactly.
Okay, got it. Thank you.
Thank you.
It would make this completely kosher if you used log utilities, because with log utilities, that the fully dynamic program.
No, it's
No, guys. Pt minus 1 would be a state variable. Yes, that's true. He shut me down. It's okay. He's the chair.
Yeah.
That's fine.
Is it okay that I...
Yes, please
yes,
proceed.
okay, thanks. Yeah, so let me talk about our dynamic solution. And the key result in our paper is that the way you should trade is that you should start from your inherited portfolio from last period, and then you should trade partially towards some aim portfolio. And this trade, the aggressiveness of your trade is determined by this M matrix. And M, you can essentially think about that as you should trade more aggressively towards the aim portfolio for more liquid stocks and less so for less liquid stocks. Now this aim portfolio looks sort of complicated, but it's actually just a discounted version of Markovitch portfolios over all future periods. And Markovitch portfolio is just the optimal portfolio if you were not exposed to trading costs. So you should sort of take the portfolio you inherited, trade towards the aim portfolio, and this aim portfolio is the optimal portfolio, a discount version of the optimal portfolio before trading costs. Now we use this result in two different ways to implement optimal portfolios with machine learning. The first one is what we call multi-period ML. And what we do here is that we predict returns over various different horizons, use that together with a covariance estimate. Then we can create the aim portfolio, and then using this first line, we can create the optimal portfolio at each point in time. Now the second way that we use this key result is what we call portfolio ML. And here we're using the fact that if you iterate this backwards in time, you see that the current optimal portfolio today is just a discounted version of all past AIM portfolios. So therefore, we can replace the current portfolio with the weighted average of past AIM portfolios in the investor's objective, and then we can use this investor objective as the loss function in our machine learning model. So this portfolio ML learns directly about the optimal weights of this AIM portfolio without using the results in this second line.
Okay. So I think this is important now for clarification. It's genuinely a clarification question. Is this the solution of a dynamic programming problem where you have, like, say, I'm going to say it again, so you have log utility for the flow, and then because of the structure of the per period log utility being quadratic in the pies, the full value function is going to be quadratic. So then you can, like, relatively easily solve the full problem. Is this what comes out when you solve the full dynamic programming problem, or is something else going on? Is this just iterating the dynamics in some way? I'm assuming you're doing the first, a solution to a dynamic programming problem, which turns out if you flip one side back, it's quadratic. It's quadratic in the state variable and the control, like it was obvious in the previous slide. And when you have log utilities, you can always convert the problem into a sequence of these quadratic flows. That just comes from writing down the log utility specification. You had a gamma there that was capturing risk aversion. That's a little problematic. And if you had Epstein's in, you wouldn't get that gamma either. It would be much more complicated. But okay, if we leave that gamma aside and we say call it 1, what I'm trying to understand is 80, where does it come from? Does it come from solving the full dynamic programming problem?
Yeah, this AT, where that comes from? Yeah, exactly. It comes from, exactly, yeah.
That's the answer to those guys.
Yeah, sorry. Thank you for that clarification. In this talk, what I'm going to focus on is what we call portfolio ML, because that's what we find to work best empirically. But we also implement what we call the multi-period ML. Now, what we show is that you can express this utility as a function of past AIM portfolio by using this key result. Then what we show is that if you express this AIM portfolio as linear in the security characteristics, then you can really get a closed form solution to this fairly difficult problem. And now this closed form solution has some components that are fairly complicated, but importantly, you can compute them directly from observable data. Now, one thing that we include is a ridge penalty to sort of regularize our solution, and we'll pick that empirically using a validation set. Now, what we have here is a portfolio that's linear in security characteristics, but we would optimally want to have a more general solution that would also capture nonlinearities. Now, what we're going to use is a simple method called random feature regression. That was exactly what Bryan was talking about earlier. It's just, Bohemian Rex shows that you can approximate any function by taking a random nonlinear transformation of the original characteristics and then making the function linear in these transformed characteristics. So what we have here is really that the AIM portfolio is going to be a linear function of these random nonlinear features. And therefore, we can get sort of like a closed form solution where the loss function is equal to the investor utility. And obviously, it has some sort of hyperparameters that we need to choose, but we will do that using a validation set. Now, we're going to compare our dynamic solution to various benchmarks from the literature. And to do that, we need to take a two-step approach. First, we need to find a machine learning model to predict returns over the next period. Then we're going to use that machine learning prediction in 3 different ways. The first one is just to use these predictions to produce a long-short portfolio. We'll call that factor ML. Second, we're going to also use information from a covariance matrix estimate to build what we call Markovich ML. And then finally, we're also going to do a static portfolio optimization, or trading cost optimization, which we'll call the static ML. And here exactly, with the static ML, you're not thinking about the dynamics of this problem, but rather you're maximizing your utility over the next period, which our solution shows is not the optimal thing to do, right? You should think about not only utility over the next period, but also how it's going to affect your investment opportunity set in all future periods. Yes, sir.
Yeah, I have a question just about the algorithms. If you were to use different algorithms relating to the talk of your co-author earlier today, how different would the results be? Have you tried anything else? And are we, looking at something that is the only thing you tried?
No, we have tried. So one thing you could do is to not create these random features and just use the standard characteristics. So that will tend to work worse than to doing this random feature transformation.
There's other solutions
Yes,
that aren't
definitely.
as good.
Exactly.
That we did random forest as opposed to neural nets.
You could
How different would the solution? Are we going to see ever, and in some iteration of the paper, some spectrum of results that you might expect? Because everybody's got their pet machine learning algorithm.
Yeah. So not right now. Now everything is sort of in this linear mapping where we use either risk regression or this sort of neural network. But we haven't tried with tree-based models.
This is the only thing you've done.
Yeah, exactly. Yeah. We could do that with. We've tried with tree-based models for predicting expected returns, and then use that in this multi-period ML, but we haven't tried with tree-based model for what we call portfolio ML. Let me just point out that all of these methods are fairly sophisticated, and especially this static ML uses machine learning, expected return, state-of-the-art risk estimates, and a layer of trading cost optimization. So as I said, it should work reasonably well, but it doesn't take into account that it only considers return over the next period, whereas the optimal solution would consider expected returns over all future periods. Now, to the empirics. We're going to consider these 5 different portfolio methods, where the first 3 are our benchmarks, the last 2 are our methods. And the distinguishing features of our methods is that they'll take these forward-looking dynamics into account. Now, in terms of data, we're using monthly data on US stocks. We are restricting our sample to roughly the 1,000 largest stocks at each point in time. We're going to use 115 different security characteristics, and we're going to estimate the covariance matrix using a factor-based model based on characteristics. So if you know the Barra model, which a lot of practitioners are using, we're going to use something very similar to that. Now for trading costs, we are going to assume that this lambda matrix is diagonal, and that each diagonal entry is proportional to the past 6 months dollar trading value of a particular stock. So it's going to be cheaper to trade stocks with a high trading volume, and it's going to be more expensive to trade stocks with a lower trading volume. We're going to consider investors of different size, but in our benchmark specification, we're going to consider an investor with a wealth of 10 billion by the end of 2020. And we're going to consider an investor with a relative risk aversion of 10. Now we're going to use machine learning, and in particular these random feature regressions, either for predicting portfolio weights in this portfolio ML method, or for predicting expected returns, which is an input for the other methods. Now, as I said earlier, we do find that if we're just implementing, for instance, this static ML method using our optimized inputs, then what will happen is that out of sample, it will tend to take on too much risk, and as a result, produce negative utility. So what we do is that we add a second tuning layer to sort of force these methods to take less risk out of sample, And we do that in different ways. We're doing that by shrinking the expected return estimates, by adding volatility to the risk estimate, or by increasing the perceived trading cost. Now, all this is doing is just to lower the risk that you're taking out of sample, and we show that that actually has a significant benefit. Now, the test period will start in 1981, and everything will be out of sample, so hyperparameters will be picked from data before this out of sample period, and we're going to update these hyperparameters on a yearly basis. Now, to the empirical results. What I show you here is the out-of-sample performance for each of these methods from 1981 to 2020. Now, here we have our two methods, portfolio ML and multi-period ML. Then we have our main benchmark, which is the static ML, and these three methods are all trading cost aware. Then we're also going to consider this portfolio sort and the Markovich ML portfolio, which are not trading cost aware. And here is the version where we're using this additional layer of portfolio tuning for this multi-period ML method and for the static ML method. Now, the first thing I want to highlight is the gross Sharpe ratio of the different methods, so the Sharpe ratio before accounting for trading costs. Now, what you see is that this Markovich portfolio dominates all other methods. So it has an annualized Sharpe ratio out of sample of 2, which is obviously very impressive. But once you account for trading costs, the cost of trading this portfolio, you'll find that the trading costs are massive. So they're so massive that we have to censor them in this table. And essentially what happens is that the Markovich portfolio takes into account these 1 period ahead machine learning based expected returns. And these expected returns will tend to work well for small illiquid stocks. They'll tend to work well for fast predictors like short-term reversal. And as a result, the turnover of this portfolio is just massive, which means that it wouldn't be feasible for investors to trade on these machine learning based expected returns without doing a second layer of trading cost optimization. So one of our first results is sort of that these standard use of machine learning models for creating portfolios is not implementable in practice. Now, when we move to Sharpe ratios after trading cost and utility, which is also after trading cost, we can start by looking at this multi-period ML and static ML. Now, what we see with only one tuning layer is that they have a positive Sharpe ratio after trading cost, but actually they'll tend to take on so much risk out of sample that the utility becomes negative. However, once you add this second layer, which we call portfolio tuning, you can actually get higher net Sharpe ratios and, more importantly, much higher utility. So this is not a theoretical statement, it was just an empirical statement that says that in general you should take less risk out of sample than what sort of appears to be optimal using in-sample estimates. Now, even if these portfolio methods work, or these methods worked well, they're dominated by this portfolio ML method. So in Sharpe ratio terms, this outperformance is around 20%, and in utility terms, it's around 60%. So what we show is that if you want to create optimal portfolios using machine learning, then you should use machine learning to find, then it seems to be better to use machine learning to find portfolio weights directly as a function of security characteristics using an economic objective which sort of forces the machine learning model to focus on predictability among large stocks, and for persistent predictors, which sort of lowers the turnover of this portfolio. And these plots just show the time series of these different methods. Now, what I just showed you was for a benchmark case of an investor with a wealth of 10 billion. But as I said, the attainable implementable efficient frontier will differ based on the investor's wealth. And in particular, if you assume that you have an investor with a zero wealth, then you're just back to this standard efficient frontier. You can get a Sharpe ratio of around 2. And then obviously, this green line was our benchmark case, so you can get a net Sharpe ratio of 1.5. But if you have an even larger portfolio, then of course you have to sort of focus on larger and larger stocks. You have to turn over your portfolio less and less. And as a result, the optimal portfolio you can create will have a relatively low net Sharpe ratio. Yes, of course.
You just leave it up here.
So it seems that when you set up the problem, you made it so that it looked that it was homogeneous in wealth. Like you went, and which was a very good motivation. Like we like that, right, normally. Here you're saying that the frontier depends on the level of wealth.
Yes.
Where did you make the problem non-homogeneous? I missed it.
Oh, no. I mean, the wealth of the investor is in the utility function. And it's just because, a larger investor will have a larger trading impact, larger trading costs, so the net returns will be lower for the same sort of portfolio trading.
I thought that you made the trade impact quadratic in the portfolio.
Yeah, in the dollar amount traded. So basically, the trading cost will depend on the square of wealth. So it ends up being that the wealth of the investor will matter for how much price impact they have. So this is exactly what's happening here. Because this huge investor has a massive price impact, then you'll have to focus on more liquid stocks. And among more liquid stocks, there's less predictability. So as a result, the implementable efficient frontier for a large investor will be much less attractive than the implementable frontier for a very small investor. Now, of course, a very small investor wouldn't be able to sort of use and implement our method. But still, it is sort of interesting to see empirically how different this efficient frontier looks for or is for different types of investors. Now, the final thing we do is that we look at which characteristics matter once you take trading costs into account. And this was actually one of the first motivations that we had for this paper, because when you do machine learning and you're not taking trading costs into account, then what you'll tend to find most of the time is that especially short-term reversal will tend to come out on top as by far the most important predictor. However, because short-term reversal tends to work much better for illiquid stocks and because it tends to be a very fast predictor, it turns out that once you account for trading costs, short-term reversal is actually not an important characteristic. So what will tend to be an important characteristic when you account for trading costs is quality signals and value signals, because this is basically a persistent predictor, so you know that if you're trading based on a quality signal, then that signal is going to be predictive of returns for multiple periods. And also, quality will tend to work very well for large stocks, which is also good when you're considering your price impact. So, to conclude, we developed a method for optimal portfolio selection when trading is costly. Returns are predictable by a general function of characteristics, and the driving state variables are stationary, thereby handling this issue of portfolio growth. So what we find is, what we would say is an intuitive solution which can be implemented via machine learning. Our empirical results show that there's significant out-of-sample gains to using this method. And we provide a novel view of which security characteristics are important for a large investor. Thanks a lot for your questions. And yeah.
We have some extra time for further questions.